Welcome back to The Deep Dive, the show where we take all that raw data from earnings season and really try to distill it down into what actually matters for a company's future. And today, we are strapping in for a really interesting one. It's Richardson Electronics, stock ticker RELL, and we're looking at their Q2 fiscal year 2026 earnings call. This one is just a textbook case of divergence. I mean, you have management, and they're proud. They're pointing to 6 straight quarters of year-over-year sales growth. And that kind of validates their whole strategy, right? This multi-year push away from legacy stuff into engineered solutions. But then here's the twist. The market absolutely hammered the stock, just sent it spiraling the second those numbers hit the tape.
And that reaction, that really sharp, aggressive sell-off, that's our mission today. We're not just here to read you the numbers. We're here to figure out why the street sold off so hard and why they ignored that really powerful top-line momentum. It all comes down to profitability. And more importantly, we need to look at management's turnaround strategy and figure out if that timeline for future earnings, if it's actually viable.
Okay, let's unpack this financial whiplash. Solid revenue beat, stock gets punished. So let's start with the hard numbers for Q2. This is for the quarter ending November 29th, 2025. Where did this disconnect on profitability actually happen?
Well, the divergence was it was profound and it was immediate. So on the revenue side, Richardson brought in $52.3 million.
This is a beat.
A strong beat, yeah, about $2.4 million above what analysts were expecting. And it's up 5.7% from the same quarter last year. So that's the good news. Now, here's where it gets interesting and why the market reacted so, violently. GAAP earnings per share, diluted, came in at -1 cent.
A loss.
A loss, when the street was modeling a slight profit of positive 2 cents per share. And that tiny, tiny 3-cent difference, that's what took them from an expected profit to an actual net loss. And for the market, especially the trading algos, crossing that line from black to red, that is a massive, massive trigger.
It's a brutal threshold. And the judgment was just swift. The stock dropped about 11.9% in the next session. But what really stood out to me was the volume. It just spiked, something like 4.1 times the typical trading volume. So people weren't just sitting on it. They were reacting. They were hitting sell. That bottom line miss just made the revenue be totally irrelevant.
It really underscores the point. Investors don't care so much about a penny miss as they do about the message a net loss sends, especially when a company is in the middle of a big investment cycle. To be fair, though, their underlying operations are getting better. Operating income improved to $0.1 million, which is way up from a $0.7 million loss this time last year. Non-GAAP EBITDA was also $0.7 million, up from basically break even. So there's momentum there.
Right, so you've got undeniable proof of better operational leverage. They're running the core business cleaner. But it just wasn't enough, was it? Not enough to overcome whatever was driving that final net loss. It's like the revenue engine's running hot, but there's a small, really damaging leak in the profitability pipeline.
That's a perfect way to put it. They're generating more operating income, but these, non-operating items and some temporary margin issues push the final number into the red. And that just triggered the panic button.
Okay, so since the operational part is getting cleaner, let's look at what's driving the top line. Management keeps talking about this shift to engineered solutions. What were the actual star performers in Q2? What are these businesses?
The strategic segments were on fire. I mean, they absolutely crushed it. And it really validates that whole repositioning idea. Green Energy Solutions, or GES, was the undisputed star. Sales there grew a phenomenal 39% year over year.
39%?
Yeah. And this was mostly driven by their power management products, specifically things like pitch energy modules that are used to serve as big wind turbines. What's really fascinating is just how fast the segment's growing. Right. They even pointed out it was up 14% just from Q1 sequentially. You're watching a real compounding growth story unfold right there.
That is a stunning growth rate. It really does sound like RELL is finally shedding that old legacy skin and turning into a green tech company, if they can pull it off. What else drove the revenue beat?
Their custom display business, Canvys, also had an excellent quarter. Sales there were up to 28.1% year over year. And this was from better demand from their medical OEM customers. So think high-end systems for things like robotic surgery, navigation, endoscopy. And a great sign for the quality of this growth. Canvys gross margin improved a lot, up to 32.6%.
Okay, so you have this really powerful mix shift happening. More green tech, more specialized medical displays. But if those engines are running so hot, What was the big problem? What was eating into the profit and causing that overall margin dip?
That brings us right to the consolidated gross margin. It ticked down a little bit to 30.8%. That's a 20 basis point decline year over year. And the decline was mainly because of lower margins in their power and microwave technology segment, or PMT, and critically, a slight margin dip even within that high-growth GES segment.
Hold on, if GES is growing at almost 40%, why would the margins be dipping? Is that them having to cut prices to win deals, or is it just the cost of scaling up that fast?
It's probably a mix. When you scale that quickly, sometimes your input costs or hiring costs can outpace your immediate efficiencies. We didn't get the fine details, but usually that indicates they're either investing heavily in inventory or maybe component costs went up because demand was so strong. And speaking of PMT, their sales were technically down 4%. But management gave some really important context there. If you strip out a partial healthcare divestiture from back in January 2025.
Which complicates the year-over-year numbers.
Right. If you take that out, PMT sales were basically flat. They're seeing good growth in high-value areas like RF components, STCOM, and drone tech. But that was offset by a little slowdown in their legacy MRO maintenance, repair, and overhaul business. That's the older, more cyclical part of the company.
So PMT is flat, GS and Canvys are booming, but the margins are soft. This raises the big question about the future, right? Is this growth sustainable? We have to look at their forward visibility.
Absolutely. And to do that, you turn to the backlog. The total backlog held remarkably steady at an extremely robust $135.7 million. And management gave some very specific color on the quality of that backlog, which should be reassuring. While the overall GES backlog dipped a little bit on timing, they shipped a huge amount in Q2, the core GES business, which is 95% of that segment, at a book-to-bill ratio of 1.10.
Okay, so what that means is even after that massive 39% sales quarter, they're still booking 10% more new business than they're shipping in their most important segment.
Exactly. That is a very strong indicator of foundational strength.
That backlog definitely validates the long-term direction. So let's look forward. Management is painting this picture of future profitability, but those margins have to get a lot wider. What specific things are they doing to make sure these sales eventually turn into real, durable profits?
The roadmap is pretty focused and aggressive, and it's moving beyond just turbine parts. First, they're pushing green energy solutions internationally. Historically, GES was about 85% North America, so this is a huge step for them. They're expanding their product platforms to include major global turbine brands like Suzlon, Senvon, Nordex, and SSB. This just dramatically increases their potential market.
And it looks like the investments are following this strategy. They're putting real capital into new infrastructure to speed this up.
They are. They expect to have a new design center in Sweetwater, Texas, up and running in Q3 of this fiscal year. And that center is specifically designed to accelerate new product development. And even more exciting, I think, is the Illinois-based Battery Energy Storage System, or BES Demo Center, that's expected to launch in Q4. The BES Center is directly targeting those huge and often very complex state rebates in places like Illinois, Massachusetts, California. They see a clear path to high-margin system sales there. And they already booked their first BESS order in December, so the market's ready.
That BES initiative is smart. It connects their expertise in power management directly to these regulatory tailwinds. But let's connect this back to the big, immediate problem, the bottom line. Management pointed to one major catalyst for margin recovery. What was that?
The single most critical piece is the transition happening in their remaining healthcare unit. Management was clear that production of the lower margin, older Ulta tubes is expected to end by the end of Q3. At the same time, the shift to repairing Siemens MX series tubes, these are extremely high-margin diagnostic imaging tubes, is set to launch in Q4.
So that's the switch.
That is the key structural change. It stops a margin bleed and flips the script. The timeline they gave suggests a return to profitability for that whole unit in Q1 of fiscal year 2027. That Q1 FY27 target is what investors really need to anchor their analysis to. That is the projected inflection point for the entire company's profitability.
Q1 FY 2027. That's a long way out, nearly 18 months from the call. A lot can go wrong in that time. How reliable is that timeline, and what happens if it slips?
And that's the tension, right? That's why the market is discounting the stock now, because of that risk. But management sounds very confident. And they also have another tailwind helping PMT. We heard very positive comments about the semi-cap recovery. They're expecting solid growth in semiconductor wafer fab equipment well into calendar year 2026 and beyond. They're tying it directly to AI-driven demand, especially for memory. So when semi-cap recovers, PMT should get a nice lift.
Okay, last piece here, cash and efficiency. If they're making all these big strategic investments,
is the balance sheet safe?
Rock solid balance sheet. They closed the quarter with $33.1 million in cash and equivalents, and they have zero debt drawn on their revolving line of credit. And the immediate efficiency gain is going to come from inventory normalization. They had this period of high investment in inventory. A final receipt of about 1.5 million euros for power grid tubes is wrapping up now in early calendar 2026. This basically secures their supply for those legacy products through 2030, and once that's done, it should really improve their cash conversion.
But hold on, they have $33.1 million in cash, but management said that about 70% of that is held overseas. Isn't that a huge red flag if they wanted to use that cash for something like a buyback? I mean, that cash is essentially trapped, or at least hard to get to without tax hits.
That is precisely the complicating factor. You're right. While the cash position looks huge on paper, the accessible domestic cash is much, much smaller. But they are trying to stay disciplined elsewhere. SG&A selling, general, and admin expenses, and overall headcount are supposed to stay flat. They're reallocating resources to the high-growth spots. They also launched a new AI steering committee to find efficiencies internally without spending a lot more money. They're trying to squeeze every last dollar out.
All right, so we've covered the numbers, the headwinds, and the aggressive pivots they're making toward that profitable Q1 27 goal. Now we get to the part of the show where we connect the dots between that market inefficiency and potential opportunity. This is the segment we call
This is not financial advice. Okay, so as we said, the market punished RELL hard for a tiny 3-cent miss. It completely ignored the $135 million backlog, the operating improvements, everything. And this gap between reality and the stock price was so obvious that shareholders on the call were really pressing management about a share buyback, because why not? The company's trading near or even below book value. It's got $33 million in cash and an undrawn credit line.
Right. The market is valuing the stock based on this temporary depressed margin mix. It pushed the price down from over $11.50 to around $10.30. Management is clearly bullish on that FY 2027 inflection point, but market's saying, show me now.
So here's our deep dive, high conviction thought exercise. The play here, we think, is to go long REL, betting on management to pivot, to an opportunistic, small, debt-funded buyback. Think about it. They could use a small piece of that undrawn revolver, say $4 or $5 million. It's a low-risk move given their cash, and they could easily service that debt. But the impact would be huge. It would immediately signal immense confidence from management. It says, we know these catalysts are real. The healthcare turnaround, the semi-cap recovery, the GES growth, they're coming and they're reliable.
And the rationale is pretty simple. You're using temporary, cheap leverage to buy your own shares below what you think they're worth while the stock is beaten down. It effectively engineers a floor under the stock until that profitability catch-up finally hits in FY 2027. And your margin of safety is that stable backlog and that big debt-free cash position. It's a trade on management's confidence versus the market's myopia.
At the end of the day, this Q2 call was a study in divergence. The fantastic top-line growth proves that the long-term strategic shift is absolutely working. But the short-term margin dip, driven by these temporary issues, triggered a deep, immediate penalty from the market.
So what does this all mean for you as you're thinking about this? The core tension is really all about time. Which story is going to dominate the stock price over the next couple of quarters? Is it the foundational strength of that $135 million backlog and the clear strategic direction? Or is it the near-term noise from margin pressures that management says will be gone by Q1 of 27? The reliability of that Q1 FY 27 date, that remains the single most important variable to watch. We encourage you to dig into the Q&A transcript yourself, look at the specifics on how they plan to use those state rebates with the BES Center and the complexities of that international wind turbine expansion. Thanks for diving deep with us today. We'll see you next time.